Hey, good evening, everyone. This is John. It is Sunday, January 9th. From a seasonal perspective, we typically peak out right here about the 5th trading day or the 5th of January. Underneath this next blue line here is the McClellan oscillator. As you can see, every time, if you look up here in the header toolbar, it'll show me price when I'm in this window. It'll show me the seasonal trend in this window, and then it'll show you that we're looking at the McClellan oscillator. The McClellan oscillator has built in a bit of bearish divergence. As you can see clearly, we are making lower highs as the marketplace made higher highs. So it's showing us that on this rally, we're seeing more issues declining than advancing. That in itself doesn't mean a lot, but when we take a look at a weekly perspective, you know, this whole advance, believe it or not, looking at the McClellan oscillator has been, or the whole advance, but at least the advance from, say, early October has been on declining issues, or advancing issues, excuse me, not outpacing declining issues. Seasonally speaking, though, the market moves up. So these two indicators were not in sync. In other words, if we were in a seasonal time frame where the market declines, then I would pay attention to the McClellan oscillator. Just like over here, McClellan oscillator, from a seasonal perspective, the market goes down, but the McClellan oscillator was going up. And that, I think, you know, when do you believe which indicator? Our indicators are saying that right now the market's kind of pausing. We're near monthly resistance, weekly resistance up in here. I'm going to go with the seasonal tendencies because typically it can be up to, even on a weekly perspective, up until next week or this coming week, the 14th. That's this week, of when we see a market typically peaking out. And that peak in price can typically last going into February or so for the E-mini S&Ps, or at least the third week of, January, by January 28th. So that's seasonal decline right there. That's what we could probably look to expect. It's February. Hello and welcome, everyone. This is John Person reporting for PA Stock Alerts. It is January 17th, Martin Luther King Day holiday, Monday. This is the S&P 500. As you can see, we've been on a tremendous tear to the upside. In this chart is the spiders, the ETF, Exchange Traded Fund, and we are approaching very close on the spiders. As you can see, this red line is the predicted monthly, 130.06, and we hit 29.30 here, the high 129.33. So we're about 70 cents from monthly resistance in the S&Ps, which so far year to date, which is kind of interesting. S&Ps and year to date, folks, just to give you an idea, year to date is 10 trading days. From the 3rd of January to the 14th, last Friday, we've only had 10 trading days, and we've seen a 2.8% increase in value in the S&Ps, 3.9% increase in value in the NASDAQ, Dow's only up 1.8%, and the Russell up 3.1%. So incredible healthy gains. The question is, are they sustainable at this pace, and for how much longer? And I'd have to argue, I think that we are seeing some sector rotation. We've seen stocks decline in the retail apparel sector. We're starting to see more strength in the financials. This particular week, last week, Wells Fargo put out an upgrade on the financial sector. And this coming week, we have probably 10 to 15 different banks, Fifth Third, USB, Citi, Bank America, PNC. We have just a few handfuls here of financial and bank stocks all coming out. Huntington Bank shares is another with earnings. So this week is going to be, besides the big tech names that probably you've already read about or know that's coming out, like Apple and Google and IBM, this is almost the bank and small cap bank sector reporting earnings week. So just keep that in mind. It's really going to be interesting to hear not only their comments on earnings, but to see if they beat earnings, but also what their expectations are going forward in this environment. I wanted to also extend the fact that even though the markets were closed on Monday, the American depository receipt stocks that trade overseas were open. Apple, as they announced Steve Jobs will be taking a medical leave, were hit hard in a European session. Just because the U.S. market was closed, the Europeans still trade on a Martin Luther King Day holiday. Foreign currencies were open as well. The Globex markets here in the S&P 500, Globex at the Chicago Mercantile Exchange was open till 10:30 this morning, and they are reopening again at 5:30 Central. So the markets do actually trade, believe it or not, electronically. And today the Nasdaq was down nearly 30 points on that news. I think they got a little bit overextended. China tightened last week, so try to curtail this inflationary commodity bubble that may be existing with energies and ag products, et cetera, et cetera. And, we saw the precious metals get, at least gold, take that under consideration as people are starting to unwind that inflation or unwind that deflation hedge, so to speak, as gold was giving a flight to quality aspect. And so gold may still see a little bit more selling pressure in the next week or weeks to come. It's interesting to note that I wanted to talk about a couple things today. What we've gone through, where we've come from, and what we are going to enter into, at least from a period of seasonal strengths and weaknesses. Generally speaking, seasonally, the first 5 trading sessions of the year are bullish, and then as we get into the second to third trading week, we see a little bit of weakness in the market headed into February, and we followed that pattern precisely last year as well. Now, this year, on or about the week ending the 14th is when we see a seasonal peak in the market. And the chart that I wanted to show you here below is a money flow indicator with which is the green line, and the blue is a 14-period look-back window. So as you can see, money flow is well above a 14-day, because this is a 14-week moving average, 14 periods that is. So the money flow, cash going into the market, is considerably higher than the 14-week average. The only thing that I'm a little skeptical about is the fact that the levels are a little bit different, as you can see, when money was flowing into the market back last April. So one or two things happen. We're going to see a correction in the marketplace, folks, that is either going to be muted in the sense that we're not going to see an aggressive sell-off, and we could just see maybe a pause in a consolidation range. And that might be the case because it's not like it's been overly aggressively bid up. There's a few stocks that have gone up, and a lot of different sectors are rotating, as I just mentioned. From apparel, we saw some apparel stocks get just absolutely bagged and tagged, and now we're starting to see some stocks in the healthcare sector pick up, and we're starting to see the financials pick up. Let's take a look at the financials, if I may. And here we go. As you can see, we have been on a strong tier. Once again, money flow is showing us that it's not going into this sector aggressively as it did last April when we were at these highs. We haven't taken out those highs yet. So I think that's, this little rounding bottom pattern, we're stuck between a rock and a hard place. The rock being this aggressive rounding bottom formation, and the hard place being a potential double top in the market right up in here. So the key is, with all these earnings coming out this week in the financial sector, we're really going to have some work cut out for us. We believe that if the market pulls back, it's going to be met with some at least aggressive buying, because there's a lot of bulls out there right now. Everyone's bullish the market. People have committed, but as you can see, the money's not in the game. It's not in the game as aggressively as it was in April, which tells me that, this pullback might not be as severe as people expect because there's not a lot to take out of the market. Not a lot of people participated in this market. That's what my interpretation of this indicator is about. So maybe we don't get the aggressive pullback, or what if this thing doesn't pull back at all and it keeps going up? That is a real event. A lot of people think that just because the market has had a pretty good move to the upside. Let's say, this is pretty good. And Tom and I were bullish back here in August, and we were buying, we were cautiously optimistic. We were petrified bulls on the run up. We've liquidated, and we've been trying to get back in. But, when I take a look at this chart, and I say to myself, gee, we've taken out the highs. We are in monthly buy mode, but we're probably getting a little ahead of ourselves. And if I take a trend line chart and I say, look, this old support and resistance areas, you can see back here in as we had in early 2008. It held a couple times, market rallied, it held, then it broke it, and then it came up and it acted as resistance. And that's the area that we're at right now. So one of two things can happen. We could be sitting here stalling for a little bit, maybe a small correction, or we blow right through that. And if you recall, there was a period in 2003 where the market rallied and everyone was calling for correction. It really never came. The market just moved sideways in 2004, and it continued to move up, and all of a sudden it continued to move up. There was a slight correction, of course, in the summer, and it continued to move up. So the markets can go a lot higher, a lot further than anyone anticipates, and that's what we need to be cautious of right here. So again, we're between the rock and the hard place. The rock being the market has built in a solid base. Money has gone into the market, but not as aggressive. So therefore, maybe one of two things happen. If the market corrects, it's not going to be as deep as we think, or B, the market's not going to correct at all and it's going to keep going, and that's when we're going to see an aggressive inflow of more capital. For those that are bullish, waiting for the market to pull back, they're just not seeing the pullback. They're going to have to eventually get into the market. So that's what Tom and I are bouncing back and forth. We're very cautious. There's a lot of stocks that we've been trying to buy. The NASDAQ futures were down almost 30 points from Friday's close. So let's just see if there's any negative ramifications that come in on Tuesday to see how we are in the marketplace.
This is Tom Aspray. I hope you enjoyed the comments of my partner, John Person. For those of you who are not familiar with PA Stock Alerts, John and I write it together. And you might say, what exactly does that mean? Every recommendation we make, we come up with together. And as you might imagine, for two guys who have over 30 years of experience each in the markets, that can sometimes be a fairly lengthy process. But in that way, we figure that we find the best stocks for our clients, also in the strongest sectors. If you're interested in PA Stock Alerts and not either a subscriber or on a trial subscription, you can join by checking on the join now for a free email. This will allow you to sign up. We do not sell our email list. It'll give you a free 1-month trial. Our updates are released Tuesday, Thursday, and Sunday evenings at 8 p.m. When the market warrants, we also send out special email alerts and also send written reports. For those of you who are subscribers, just a reminder to log on to the members section. All you have to do is type in the email address that you used to register for the service. I'll use mine. And then type in your password. Once you've entered your password, just hit log on. That'll take you to the members area of our website. It'll show you when the latest video was available. This one was updated as of January 18th. Also, you can click here to see our current positions. That will tell you all of our current positions we're holding, our new recommendations, protective stops, price objectives, etc. Once again, I hope you enjoyed the video. Expect another one in the next week or so, if not sooner. John has one he did on the COT data and sectors to look for in 2011 that we may post by early next week. Thank you very much.